Hello everyone, welcome to SWAYAM BHU course on Fundamentals of Economics and Financial Markets. Myself, Dr. Anand Singh, and under this program, I will be discussing with all of you regarding the topics which are concerned with the financial market. Now, in this particular video, that is the first topic, it is basically concerned with the Indian financial system. Now, in this particular topic, I will be discussing with all of you on 7 major key points. Now, those key points are: point number 1, what is the meaning of Indian financial system? In this particular topic, we will discuss regarding what is the exact meaning of Indian financial system and how we can define the Indian financial system. Now, the second point or the second key point will be concerned with the major components of Indian financial system. Under that particular segment, we will discuss regarding what are the major components or what are the major segments of Indian financial system, or how we can define or how we can basically segregate our Indian financial system into major components. Now, the third key point which we will discuss in this particular topic is why sometimes Indian financial system is regarded as very complex in nature. Why it is said that Indian financial system is very complex. Now, the fourth segment or fourth key point which we will discuss under this particular topic is why it is called that Indian financial system or the components of Indian financial system are sometimes interrelated or they are sometimes intermixed with each other. Why it is called so? We will discuss this particular point in key point number 4. Now, the key point number 5, it is basically concerned with the financial assets. In that particular thing, we will discuss regarding what is the meaning of financial assets and what are the important features which are associated with the financial asset. In the key point 6, we will discuss regarding the basic differences between the financial assets and non-financial asset. In that particular point, we will discuss regarding what is the meaning of financial asset, what is the meaning of non-financial asset, and what are the key points of differences between the financial assets and non-financial assets. And in the last segment or the key point number 7 of this particular video, the first video, we will discuss regarding the regulatory bodies. We will discuss what is the meaning of a regulatory body and what are the important regulatory bodies which are directly or indirectly concerned with our Indian financial system. So, we will discuss this topic, that is Indian financial system, on these major 7 key points. Now, let us start the video. First one, what is the meaning of Indian financial system? Now, whenever we define the term Indian financial system, we simply say that Indian financial system is very complex, interrelated and intermixed system of financial assets, financial institutions, financial services, financial markets and regulators. So, from the definition, it is very clear that Indian financial system is something which is regarded as number 1, complex in nature. It is said to be complex in nature. Number 2, it is also said that Indian financial system is basically broadly categorized or it is divided into 5 major components, and those components are: number 1, financial assets; number 2, financial markets; number 3 is financial services; number 4 is financial institutions, and last one is regulators. That means our financial system is basically divided into 5 major components. Now, it is also said that according to the definition, all these 5 components or all these 5 segments, they are interrelated and intermixed with each other. Now, let us understand that why our financial system is regarded as complex in nature. Why some people says that Indian financial system is very complex in nature. Now, to understand this particular thing, let us discuss in a specific manner. Say, when I am saying that as such our Indian financial system is a very broad system and this particular system is divided into 5 major segments, and those 5 segments, they are further divided into large number of sub segments, and further those sub segments are again divided into large number of sub segments. Now, those sub segments, they are having again their own features and characteristics. That means the whole system is divided into certain segments and further into sub segments, and all the segments and sub segments, they are having their own features or characteristics. That's why the overall system is very complex in nature, because the system has certain features which is divided into subsystems, and subsystems again have their own features, and those subsystems are again divided into various subsystems, and all those subsystems are also again having their own features and characteristics. So, overall the system, the Indian financial system becomes very complex in nature. That is why it is said that Indian financial system is very complex in nature. Now, we will discuss regarding why it is said that the segments, they are either interrelated or intermixed with each other. Why it is said that all the segments, they are somehow interrelated or intermixed with each other. Now, in order to understand this particular point, we will discuss this particular point with the help of an example. Now, suppose I ask you that whether you can imagine about a market, and that market is not dealing with any kind of product, or it is not dealing, or it is not rendering any kind of services. Can you imagine such a market which is not dealing with any kind of product, and at the same time it is not rendering any kind of services? That means either it is not dealing with the product or it is not dealing with the services. Can you imagine about a market? No, it is almost impossible, because whenever we talk regarding a market, then it must be dealing either with a product. That means it must be either deals with the buying and selling of a product, or it must be rendering any kind of services. So, if we talk regarding a market, then it is 100% obvious that either it is rendering a product, or it is dealing with a product, or it is basically rendering any kind of services. But what we have done in the Indian financial system, we have basically segregated our financial markets with the financial assets. Now, can you imagine about the financial market without the financial asset? The financial assets, they are basically a kind of product of our financial market. They are going to be traded under the financial markets itself. But what we have done here, we have segregated the financial markets with the financial assets. Now, it is not possible, or we can't imagine the market without the financial products. In the same manner, we can't imagine about the financial assets without their markets, because the financial assets, they are going to be traded in the market. Both of them, that is why it is said that both the segments, that is financial assets or financial markets, they are either interrelated with each other, because the financial assets are basically concerned with the financial markets. At the same time, they are sometimes intermixed with each other, because where we are going to trade the financial assets, they are going to be traded in the financial markets itself. That is why it is said that the components of the financial system, that means suppose these two components, financial assets and financial markets, they are interrelated, and most of the time they are also intermixed with each other. Now, let us take another example. Suppose we are discussing regarding the regulatory bodies or the regulators. Can you imagine that the regulators, they are not regulating, or they are not preparing rules and regulations for any system? Can you imagine about a system which is not basically regulated by any kind of regulatory bodies? No. If regulators are there, then they must be preparing certain rules and regulations for the system. So, how we can differentiate the financial markets with the regulators? Because the regulatory bodies, they are basically, they frames rules and regulations for necessary supervision and control, to impart necessary supervision and control over the financial markets itself. Now, it is the basic requirement, it is the responsibility of the regulatory bodies to frame rules and regulations, to draft necessary acts or rules and regulations, to draft necessary laws, so that supervision may be conducted over the financial markets for the smooth functioning of the financial market. So, how we can segregate the regulators with the financial markets? In absolute terms, both these things, that means the regulatory bodies and the financial markets, they can't be segregated from each other. Now, whether the regulatory bodies, they are going to frame the rules and regulations for the financial assets or not? Yes, it is obvious, because the financial assets, they are having their unique features, they are having their own features and characteristics. Now, who basically defines such kind of features, or who basically frames the rules and regulations for the financial assets? They are the regulatory bodies. But what we have done in our Indian financial system, we have basically segregated the regulators from the financial markets. We have segregated the regulators from the financial assets. Now, in absolute terms, all these components can't be segregated from each other. So it is clear that all these segments, they are somehow either interrelated or at many times they are basically interrelated with each other. Now let us take one example more. Now suppose we are discussing regarding the financial services and say the financial markets. Now where the financial service providers will deliver or where they will render their services, it is obvious that they are going to perform or they are going to deliver their services in the financial markets itself. Now, who is going to render such kind of financial services? Again, the financial institutions. There are large number of institutions in our country who basically provide services. They are service providers. Now, but what we have done here, we have segregated the financial markets with the financial services and with the financial institutions. Now, in absolute terms, all these three components can't be segregated from each other. That means we can't segregate the financial markets with the financial services. We can't segregate the financial markets with the financial institutions. At the same time, we can't segregate the financial services with the financial institutions, because all of these things, all of these components, they are directly or indirectly related with each other, and most of the time they are also intermixed with each other. So in absolute terms, we can't segregate all these components from each other. Now there is a question, then the question arises, then why we have segregated all these components from each other? Because in the initial definition itself, we have said that Indian financial system is basically divided into 5 major segments, that is financial assets, institutions, financial markets, financial services and regulators. Then why we have segmented all these 5 components in our financial system? The answer is merely to understand the concept of each of the segments. Merely to understand the concept of financial assets. What is the meaning of financial asset? What are the important features of financial assets? Number 2 is, what is the meaning of financial markets? What are the important components of financial markets? What are the important features of all the components and financial markets itself? Third one is, what is the meaning of financial institution? What are the important features which are associated with the financial institutions? Fourth one is financial services. What are the important features of financial services, or how we can define the financial services? And last one is the regulators. What is the meaning of regulators? Who are the regulatory bodies in our country, and what are the important features with those regulators? Merely to understand the concept of each and every segment, each and every component, we have divided our Indian financial system into 5 major segments. Otherwise, it is 100% clear that all these 5 components can't be either segregated or they can't be basically separated from each other in absolute terms. So it is absolutely clear that all these 5 segments, they are either interrelated or they are intermixed with each other. Now let us move to the next topic. Now our next topic is, what is the meaning of financial assets? What is the meaning of financial assets? Now financial assets, this is one of the main component of Indian financial system. So it is extremely important to understand the concept of financial asset. Now what is the meaning of a financial asset? Financial assets are those assets which basically fulfills the 3 conditions. That means if any asset, it fulfills 3 important conditions, then we can say that that particular asset may be regarded as a financial asset. Now what are those 3 conditions which must be fulfilled by any asset in order to be regarded as a financial asset? The first condition, or the condition number 1, is it must have an intrinsic value, or it must have a face value. Now whenever we are saying regarding the face value or intrinsic value, we should understand about the concept of face value or the concept of intrinsic value. Now let me explain this particular point with the help of any example. Now imagine about a currency note. Suppose you are having a 100 rupees currency note. Now what is written on the face of that particular currency? 100. On the currency note of 100, the face value is 100, because what is written on the face of that particular financial asset? That is rupees 100. That means face value basically defines that value which is written on the face of any financial instrument. Whatever is written, suppose you are having a share and on the face of that particular share or on the paper or on that particular specific share 100 is written, that clearly means the face value of that particular share is rupees 100. Now, so face value is very clear. Whatever is written on the face of the financial instrument, that is basically the face value. But what is intrinsic value? Intrinsic value might differ from the face value. Now, let me explain this particular point with the help of an example. Suppose we are taking the example of Reliance Industry. Reliance Industry is basically offering a share. Now, the value of share, the face value of the share was rupees 100. Now, but the Reliance is offering those shares at 10% discount. Now, what was written on the face of that particular share? Rupees 100. That means the share's face value is rupees 100, but it was offered by the company at a discount of rupees 10. So, its intrinsic value is 100 minus 10%, that is rupees 90. So, intrinsic value is basically the actual value, that value upon which the share or that particular financial instrument is going to be transacted in the market. What is the actual value? In that particular value which the share will be or that financial instrument is going to be traded in the financial market. So, the first component was, or in order to be regarded as a financial asset, all the instruments must be having either a face value or it must be having an intrinsic value. Now, it is also seen that in most of the financial asset, whether you are talking regarding any share, you are talking regarding the currencies, you are talking regarding the bonds, derivatives or any kind of financial instrument, all are having a kind of face value. But it is possible that their face value is basically different from their intrinsic value. It depends upon the market conditions. But what is the most important point which we should understand, that all are having a kind of face value or all the financial assets must be having a kind of intrinsic value. Now, this feature is more or less, it is basically applicable upon all kind of non-financial assets also. For example, suppose you are having a pen. Now, that whether there is a price for that pen or not, yes, there is a specific price, it might be MRP, it might be at discounted rate, but it is having also a price. Now, so more or less this particular point number 1 or face value or intrinsic value, it is applicable upon all kind of assets. Now, point number 2, the major point, what is the important feature of a financial asset? Point number 2 is it must contain the name of its issuer, or it must contain the name of its issuing body, or it must contain certain holograms, or it must contain certain monograms. So, the second important feature which is associated with the financial assets is it must contain the name of its issuing body. That means, who has issued such kind of financial instruments, the name of the issuer must be clearly mentioned on those instruments. It must be clearly visible, it must be containing the official hologram or monogram of that particular company or the releasing body. Now, suppose let us take an example. Now, whether the currencies, who has issued those currencies, whether the name of the issuer of the currencies is written upon the currencies or not, yes, on that particular instrument or on that particular currency, it is clearly mentioning the name of the governors or the government of India. It is clearly issuing, or the governor, it is properly stamped by the government of India. It clearly mentions that मैं धारक को इतने रुपये अदा करने का वचन देता हूँ. So, certain things are clearly mentioned upon the currency notes. Now, let us take the example of the shares. Whether it contains the name of the issuing body or not, yes, the name of the company is clearly written on the face of those instruments. The bonds or debts or the derivatives, all of those things, all of those financial instruments clearly contains the name of its issuing body. Now, this particular point is more or less, it is also, it can be found in non-financial assets also. For example, suppose you are taking the example of a pen. Whether a pen is basically containing the name of its company or not, yes, it might contain the name of its issuing body, but suppose we are taking the example of a chair, table, fan or any light. It might contain the name of its issuing body, at the same time it might not contain the name of its issuing body. That means in the case of non-financial asset, the name of the issuing body might be there, it might not be there. But if it is the case of the financial asset, then it must contain the name of its issuing body. So, the second point was name of the issuing body. It must be present in the case of a financial asset. Now, the third point, which is the most important point in order to define a financial asset, that is whether those assets or whether those financial assets are properly backed up by any fixed assets or not. Now, in the case of financial asset, it is 100% clear that, or it is 100% obvious that those financial assets must be issued by the companies or by their releasing organizations by backing them, by properly backing them with certain fixed assets. Now, in the case of non-financial assets, they are not properly backed up by the fixed assets. Now, let us take an example in this particular case or in this third point number. Now, suppose let us imagine whether the government of India can float endless amount of currencies in the market. No. Why? Because all these currencies, they are properly backed up by gold reserves or the foreign exchange reserves. Suppose, for example, suppose the government is having 100 rupees of gold or the valuation of gold reserves are rupees 100, then the government can float a maximum of 3 times or 4 times of that particular reserves in the market. That means all those floated currencies, they are properly backed up by certain gold reserves or foreign exchange reserves. In the same manner, whether all the companies, they are permitted to float endless amount of shares in the market? No. The company's shares, whenever the company issues its shares in the market, all those shares are also properly backed up by certain fixed assets. That means the assets which are under the positions of the company itself. So, whenever a company is floating its securities in the market, its shares in the market, its bonds in the market or its debentures in the market, all those things, all those financial instruments are properly backed up by the fixed assets of the company. So, the 3 important features which must be present in the fixed assets are, let me tell you regarding all the 3 points again. In order to be regarded as a financial asset, asset must satisfy 3 important conditions, and those conditions are: number 1, it must have a face value or it must be having an intrinsic value, and point number 2 was it must contain the name of its issuing body or it must contain hologram or it must contain a monogram. And the third point or the third feature of financial asset was it must be properly backed up by certain fixed assets. So, if we find all these 3 important features in any asset, then that asset will be regarded as a financial asset. Now, let us move on, and in the next segment we will discuss regarding the key differences between the financial assets and non-financial assets. Now, here we will differentiate between the financial assets and non-financial assets on the basis of certain parameters, on the basis of certain components. Now, let us discuss. Now, the point number 1, in case of financial assets, the value is basically derived from their face value or from their intrinsic value. Whenever the case is of a financial asset, then its value is basically derived from its intrinsic value or its face value. But in the case of non-financial assets, their values are basically derived from their physical value. It is not from their intrinsic value or it is from their face value. No, their values are basically derived from their physical value. So, the first point of difference was, in the case of financial assets, their values derived from their face value or their intrinsic value, but in the case of non-financial assets, their values basically derived from their physical value. Now, the second point of difference is, in case of financial assets, it is properly backed up by fixed assets, whereas in the case of non-financial assets, they are not properly backed up by certain fixed assets. Now, the third point of difference, which is one of the most important difference. In case of financial assets, they are basically, they provides liquidity to the companies, or they provides liquidity. They are highly liquid instruments. Whereas in the case of non-financial assets, they are not highly liquid as compared to the financial assets. I am not saying that if it is a financial asset, then it is 100% liquid. No, we know that there are large number of shares, there are large number of bonds. They are having, in case of bond, they are having a kind of maturity period. That means they will be matured after that specific period. But whenever we compare the financial assets with non-financial asset, then it is said that financial assets are more liquid as compared to the non-financial assets. Now, why they are issued? The next point of difference is why they are issued. In the case of financial assets, they are basically issued by their agencies, their companies, or whosoever is issuing. They are basically issued in order to generate revenues or in order to maintain the liquidity of the firm. Whereas the non-financial assets, they are basically used by the companies as collaterals. They use the non-financial assets in the form of collaterals. And let us take some examples. In the financial assets, we can give the example of shares, bonds, debentures, derivatives, mutual funds instruments. All these are basically the examples of financial assets. Whereas in non-financial category or non-financial assets, some of the examples are gold, silver, pen, duster, table, etc. Now, let us move to our last segment, that is regulator. Now, in this particular segment, we will discuss regarding what is the meaning of a regulator or who are the regulatory bodies, and later on we will discuss regarding some of the important regulatory bodies in our Indian financial system which are actively participating in our Indian financial system. Now, regulators, they are basically, or the regulatory bodies, they are basically those institutions who frames rules and regulations for the smooth functioning of our financial system. They prepare rules and regulations so that our Indian financial system can operate in a smooth manner. Now, it is extremely important to know about some of the important regulatory bodies who are basically participating in our financial system. For example, SEBI, Securities and Exchange Board of India, that is the regulatory body for our financial markets. In the same manner, IRDA is there, Insurance and Regulatory Development Authority. Now, IRDA is basically the regulatory body for all the insurance companies who are operating in our country. In the same manner, AMFI is there, Association for Mutual Funds in India. It is basically a regulatory body for the mutual funds which are operating in our country. Now, in the same manner, AMFI is there, or in the same manner, RBI is there, Reserve Bank of India. It is basically the regulatory body for all the banking sector in our country. And last, Ministry of Finance, it is basically the regulatory body for the entire financial system. Now, let us discuss in detail about these regulatory bodies. SEBI. SEBI was established in 1988 as an interim administrative body which was working directly under the Ministry of Finance. Now, in 1992, the Government of India passed SEBI Act 1992, and SEBI became the main regulatory body of our Indian financial markets. Now, after the enactment of SEBI Act, SEBI passed the free pricing era, which was one of the most important decisions which was taken by SEBI, and that was basically concerned with regarding the pricing of the securities. That means how the prices of the securities will be determined. Now, in the same manner, the second regulatory body is RBI, that is Reserve Bank of India. We know that RBI Act 1934 was passed by the government on the recommendation of John Hilton Young Commission, which was also popularly known as Royal Commission. Now, we know that in 1927, John Hilton Young Commission or Royal Commission, it basically presented a gold standard and RBI bill in the parliament, but it was turned down. And later on in 1929, the Central Investigation Committee, it again strongly recommended for the establishment of RBI. And soon after the establishment, or when the Government of India passed RBI Act 1934, in the year 1935, which came into effect from 1935, RBI became the main regulatory body of our banking sector. Now, some of the important features or some of the important roles which are basically played by RBI in our banking sector are: number one, it is mainly responsible for framing the monetary policies in our country. Second one is, it has the sole right to issue currency notes. Third one is, it acts as the agent of central government as well as the state governments. And lastly, it basically maintains the India's foreign exchange reserves system. Lastly, we will discuss regarding AMFI, Association for Mutual Funds in India. Now, this particular body was constituted, or it was established in 1995. Now, let me clear, AMFI, although it is regarded as a regulatory body which basically looks after the mutual funds, but it also comes under SEBI. That means SEBI directly supervises the AMFI, but then also AMFI is the regulatory body for mutual funds which are operating in our country. As such, currently there are 44 assets management companies of mutual funds which are directly supervised by AMFI in our country. Now, what was the basic objective? Why AMFI was established when SEBI was already there? Now, the basic objective behind the establishment of AMFI was to safeguard the interest of the investors who are making investments in mutual funds. So, AMFI was basically established in order to safeguard the interest of the investors who are basically investing in the mutual funds. Now, in the next video, I will be discussing regarding the financial markets on 7 major points. Now, all those points are: what is the meaning of financial markets? What are the key components of financial markets? What is the concept of a maturity period? What is the meaning and concept of money market? What is the meaning and concept of primary market? What is the meaning and concept of secondary market? And what is the meaning and concept of capital markets? So, thank you for watching.